Amazon kind of hitting the brakes on the real estate side, having already worked on the layoff side. What is that telling you about the technology sector right now, the prudence that it's kind of going through?
Well, it's definitely different than it was 12 months ago in terms of the general philosophy for the backdrop, both in terms of, in Amazon's case specifically, it's a company that overhired during the pandemic, put a lot of capital to work in logistics and fulfillment. We're just talking about the headquarters being put on pause. And the challenge for Amazon is, twofold. You have this highly profitable growth business, Amazon Web Services, that's starting to slow. But more importantly for them, they're really a physical business with a digital front end. And as a result, there's only one way to get out of that situation when you overinvest. And you either have to significantly reduce your footprint, which is really hard for them to do because of the nature of what fulfillment and logistics represents. So they have to grow out of it. And they have to get efficiencies on a unit profitability basis. And that's what the company is grinding through right now. And then when you exacerbate that with a tough economic environment, it just makes it that much harder and that much longer to recoup and start to actually drive some leverage out of those investments that they've made.
The other story of the week has been earnings, and I think about names like Dell and then contrast that with Broadcom, and we're getting kind of really mixed signals about demand from corporate America, global corporates, and the consumer. Kind of what's your tea leaves read of this week and what we're seeing from tech?
Yeah, well, I would say broadly the entire earnings season, if we wanted to unpack that, and this was just a continuation of that, and that is that if we look across sectors, semiconductors are always the leading indicators for global economic growth or global economic slowdowns. And we've seen a material slowdown there. Most companies lowering expectations pretty materially for the year. But nonetheless, the stocks have actually been responding all right, which is really encouraging because semiconductors are the first ones to actually start to discount the upturn as well. And they're incredible businesses with great industry structure. But nonetheless, that's where we're at, and they're highly economically sensitive. And then you have kind of the secular growth stories and software and internet and other sectors where things are still growing, but they're just not growing nearly as fast as the economy starts to take hold, as well as there was just so much capital that came into the space over, a 5 to 7 year period. And the market's really starting to discern now within these names on the unit economics and, companies that have, really good, strong, durable, competitive positions, really durable unit economics. And those are the companies that are likely to perform as we get to the other side of this, economic situation that we're in right now.
And strong balance sheets. And I just want to bring this particular point that was really driven home by GSAM a little bit earlier. Just take a listen, Denny.
Tech is getting grouped in with growth, quote unquote, if you will, but there's a lot of quality. There's good balance sheet. There's a lot of cash. There's the ability to still do M&A and strong activities. And so, again, we're really focused on there are some strong, solid micro stories, and it's less, hey, let's buy the index.
Are people sort of throwing babies out with bathwaters, to use that awful phrase, but ultimately people tying everything up
some
with
pretty
growth?
big babies in there if you're throwing those out,
Or have we now discerned that Microsoft, which I think is your largest holding, some other companies are of a different beast and actually perhaps don't see them as growth stocks in the way that you used to?
Well, I think it's twofold. There are a couple of dynamics that are going on. If we just think about what I call the giga caps, okay, so kind of think about FANGMA, broadly speaking, we have started to see a lot more discernment in terms of the multiples. We've seen where, Google's traded much lower in terms of its, expected earnings multiple. Microsoft and Apple have continued to hold their multiples, I think just given the confidence in those business models over the longer term. And all of these companies are getting a lot more competitive with each other. If we just think about the idea of AI and what we've seen with OpenAI and ChatGPT and the potential implications to Google's search business, but that's all upside for Microsoft. And so the market's trying to figure out what this is going to mean over the longer term. And then, I would say 2022, we just kind of threw everything out, with the bathwater. And then early this year, we've had this risk-on rally, not, the last, week and a half or so, which has been a little choppier, but coming into this year now, like it's one of those classic early cycle potential rallies. I don't know if it's a bear market rally. I don't know if it's an early cycle rally, but it feels more like an early cycle rally because everything then rises. And then what usually happens is you get 6 or 9 months down the road, it's the companies that have the real financial performance that really start shining through. And that's where you start to generate your returns over a multi-year basis in tech.
Okay, you mentioned ChatGPT,
Yep.
and one of the key mega caps that has outperformed so far this year is Nvidia. I know it's a holding of yours. Are you making bets now on who is best placed in the artificial intelligence race right now?
Yeah, we are. You know, obviously, as you mentioned, Nvidia is an obvious one for the moment because the fact of the matter is you can't deploy GPT without a ton of GPUs, right? I mean, it's just like that's what it is. And now, is that going to persist? You know, there's still the opportunity for companies to develop application-specific processors that might be more efficient for certain types of models, so that's a risk. One of the most amazing parts of NVIDIA's growth story over many years has been CUDA, its software platform for developers that makes it easier to program against GPUs and sort of has allowed it to win the race. Is that going to be a competitive advantage in a world of generative AI and large language models? We're not quite sure on that. But for now, there's probably no cleaner play than NVIDIA. But as you start thinking across the ecosystem, you know, it's interesting. We just mentioned Microsoft, for example.
Yeah.
Anything they do with Bing is all upside, you know? And could they potentially displace Google as the default on iOS?
Could they?
What do you think?
They potentially could. It's clearly in their ambition, and all things equal, if you're Apple, you just want to provide a consistent user experience. And you want to extract as much economic value as you can.
GPT, GPU, I'll hit you in another acronym that Kara and I have been hearing every day, Fomo.
Yep.
That was clumsy by me. Is what we're seeing in the market broadly FOMO? You know, C3AI is a name. It's up another 30% today. Based on fundamentals? I think not.
No, it's not. And so FOMO is driving. So when I talked about that classic, so we have two things. We have kind of had that classic early cycle behavior in terms of the market, and then we also have, you know, the thematic artificial intelligence kind of, you know, investing environment that institution and retail investors get behind. And it's easy to kind of throw some capital at some names like that. But and so the reality is, like, that is a lot of FOMO, right? Because the fundamentals haven't changed that much. There aren't a lot of pure ways to actually play artificial intelligence. And it's really going to be more of what can actually enhance the value of an existing business, you know, where companies are well positioned on the infrastructure side to, you know, benefit from, you know, the massive build outs that we're going to actually have to see to support this. But we're also going to see a ton, we always see this, a ton of speculation around the edges and sort of maybe some of the less proven, but, you know, a company that has AI in its, you know, name.
Right?
So yeah, exactly.
Well, let's go from AI to VR, because Ed was helping break great scoops on Meta today, and ultimately this company is having to cut prices of its pretty expensive virtual reality headsets. That still, there's a lot of hope, a lot of hype, but perhaps not the purchasing that many had anticipated. But you've been adding to your Meta position.
Yes.
What was on the back of that?
Yeah, so it's interesting. It's not because of AR, VR, to be clear.
Interesting. It's not the metaverse.
It's not the metaverse. You know, the metaverse is like, it's this thing we've been talking about for many, many years, and it's going to evolve more slowly, right? Because you're going to have a bunch of different metaverses, consumer, enterprise, different use cases. What's interesting about Meta, one is the stock got too darn cheap, okay? The expectation was, you know, they had to do something to repair their stock price and get aggressive with their cost structure, and they did, so that was part of the thesis. But there's another part of the thesis, too, and that is about 18 months ago, Apple effectively exercised its market power, and you had two things. You had IDFA.
You mean iOS ad tracking?
Yeah,
okay.
Yeah, exactly, or reduced ad tracking, right? With IDFA and ATT. And
acronym central today, are we?
there are two more, and that really hurt Meta. It really inhibited their ability to drive return on ad spend because they lost the ability to retarget and measure consumers across the broader internet. Now, what's interesting is they are one of the largest buyers of GPUs right now on the planet. They're re-architecting their data centers. The reason they're doing it is they're all in on AI. to drive better ad measurement. To the extent they're able to do that, they might actually widen their competitive advantage over time. And it's kind of like maybe a not quite as obvious way to think about a company that could benefit from AI, given how bad it's been hurt by Apple so far.